Hello, everyone, and welcome to our K-1 and Pass-Through Entities series. My name is Dave Stauffacher, the Senior Credit Trainer with Lenders Online Training, where we help lending and credit professionals say yes to good loans. Linda Keith, our company's founder and Chief Credit Trainer, is joining me here today. Hi, Linda. How are you?
Hello. I'm doing great. How are you?
Awesome. Excellent. Thank you. Linda, got another question from our viewers, and I think it's perfect again for our K-1 pass-through series. The topic we're going to talk about today is actual cash flow to the owner using 1120 K1, 1120S, K1. Now, on another live stream, we talk about the 1065 K1. It turns out they're actually different.
Yeah.
So, in fact, Linda, I've noticed that this has probably been on the minds of our lenders, especially in our online training classes, because we have case studies that actually discuss this and what we do with K1. So, Linda, before we focus on the actual K1, the cash flows of that, why are there so many lines on this K1? There's 20 lines, and then if I remember on the backside, there's all these codes. What does it mean?
So, once again, there is a lot of information that our lending and credit professionals can safely ignore, but especially when there's something on there that seems to be a negative and it's a huge number, and no, I don't usually use it, but wait, can I really ignore that number? Yes. So we do need to be sure that our folks know what we do use and what we don't. So why are there so many lines? And actually, I counted up just for this live stream. I'd never counted it before. There are 18 lines and over 100 codes for those lines. Only one of them counts. One line counts, and possibly two codes on that one line. That's it. So the reason for all the rest of them is that the tax preparer of the next tax return needs to know something. They need a number to calculate a limit. They need to be able to compare capital loss limits at a personal level, no matter where they came through in the pass-throughs. They need to understand the alternative method for calculating the qualified business investment deduction, QBI. So the good news is we don't need them. The preparer needs them. We'll let the preparer mess with them and let's us focus in on what we really need. So there's a go-to line that most everybody that has learned anything knows about. And then there is a sleeper line that I'm very concerned that even experienced lenders are skipping altogether when they should not. So let's go with the go-to line first. That's to you, David.
Line 16 is the go-to line, everybody. That answers your question. But it's called items affecting shareholder basis. It's not called distributions. So a lender sometimes needs to kind of figure that out and look beyond that. So items affecting shareholder basis. Now, not every item is affecting the shareholder basis is cash flow, Linda. I mean, we look for, here's one of the codes, D, distributions. That's it. Code D. Now, there may be another one, but I'm just saying that's the one I focus on because that's money that is going out of the company to me, the individual. So if the owner works for that company, we understand of how they get paid. Could get paid by wages, most likely. Perhaps they get rent. They're renting the facility to the operating company or another ones. So the distributions are often part of the compensation to begin with, right? I might have a set salary, and then I'm going to get most of it in compensation. We actually have a live stream on that talks about how do owners get paid in this topic. So, of course, we'll cover that in depth on the 1120 K1 modules in our training course, which we have 3 on the 1120S series. So that's important to understand. So, Linda, we talked about distributions, but what about capital? How's that contributed? Where does that show up?
Well, it's kind of funny because I had somebody in one of my classes once who said, oh, isn't that, and he gave me a line number and a code of G, and I'm thinking to myself, oh my gosh, did I miss something? No, the one thing that is there, it's called contributions, and it's charitable contributions, not capital contributions. So capital contributions are on a 1065 K1, but this live stream is about the 1120S K1. So it's actually not there. And David, can you tell them if they don't have what the individual took, what on the pass-through entity tax return might give them a clue.
Well, it's a little bit of a workaround. So what we can do, we can ask the borrower, and maybe we don't have access to the borrower right away. So we're going to document a question for our follow-up call, but we might be able to see it on the M2 for the total contributions. Now, comparing the beginning of the year, what we do is what the beginning of the year versus the end of the year in the additional paid-in capital on the balance sheet. Remember the balance sheet? I love that focus on that point. You see that there is changes and increase. There's money going into the company. The caveat, that's not for one specific owner, that's for all the owners into the entity. So we got to be careful of that, especially when we're doing a global cash flow, but we're looking at the entity of that. So Linda, I heard about that the line 16, the code that lenders often ignore, but is that always a good idea?
You mean that's that sleeper one I told you about? Yeah. So 16D, code of D, distributions, usually what we use. And to David's point, if you have the entity return, which you may not have, but if you did, and additional paid-in capital hasn't changed at all, then you know your borrower didn't put any in. But if it has changed or there are capital contributions, you don't know who did it, right? So you may be able to determine that no, there were none because you have that. But do you even have the entity return? Not always. So what about the sleeper? Well, line 16, items affecting shareholder basis includes code E, which is a repayment of loans from the shareholder. Repayment of loans from the shareholder. So I'm going to give you an example from my own experience to illustrate this. And it turns out that between David and I, we are not short of our own experiences to demonstrate pretty much anything. But here's a good one. During the Great Recession, 2008, 2009, when the banks really kind of pulled in the carpet on spending any money they didn't have to spend, right? So we were trying to protect capital during a real disruption for banks. I actually was a shareholder of the 92nd bank to fail in 2009. No, I was not a director. I was not an insider, so it couldn't be my fault. But I had a right up front seat as to how banks were in fact failing and why they were failing. So as you can imagine, since my company was a training company and my clients were banks, they kind of disappeared there as a training customer for a while. So like so many other businesses facing disruption, whether it is currently the disruption of tariffs, whether it was the pandemic, or whether at that point it was that my client base was banks, at the beginning of these disruptions, you just don't know how bad it's going to be. You don't know whether you should keep your staff or lay off staff. You don't know whether you should continue this marketing push or continue opening this new headquarters or whatever. You don't know how soon to lay people off if you're going to have to. So there's a lot of uncertainty. So I kept the staff. I stopped paying myself, which the good news is I was able to do that and willing to do that. So that actually should be a plus, even though some lenders would go, oh my gosh, you went 2 years without paying yourself. That's a bad thing. No, it's a good thing that I could go 2 years without paying myself. But so I went 2 years, cut back on my own compensation, started lending money to the company to keep the staff, eventually did lay off staff after it went on long enough. And actually, it was my husband, also a business owner, who had the foresight to say to me one day, Linda, is there a stop button to the amount you're going to lend to your company? Boy, that was a good question. So there was a stop button. I picked the stop button and I did stop at that point. The good news is the company made it through. And in fact, after the recession, we built back even better than before. Well, so think about it. As we're coming back out of this, I go back to paying myself wages and distributions. And many S-Corp owners will pay a combination of wages and distributions because we don't pay payroll taxes on the distributions. So there's a benefit to paying distributions as well as wages. So I go back to that, except the company owed me money. So I'm just going to throw out numbers, weren't really my numbers, but let's say that I wanted distributions. In addition to my wages, I was going to take 30,000 a year, except that the company owes me 50,000. So the first year that the company can start paying me back, I've got 30,000, line 16, which code? Code of E. Next year, I want to take 30,000. Well, there's 20,000 left in the loan. And so I take 20,000 code of E and now 10,000 code of D. Third year, loan is paid off. And so the third year after all this started getting solved, I have code of D for the 30,000. Imagine for a moment that your guideline simply says line 16, code of D. That's the only thing we pay attention to. Then you've got me down at 0, 20, was it 20? 10, 0, 10, and 30. At which point you might say, oh, that's not consistent enough to use it all. If instead you added D and E because you knew I was 100% owner because you asked, so there's no other shareholders that have to agree to pay that money back to me. I'm the one deciding. If you added D and E in that circumstance, you got 30, 30, 30. And also a company that, liquidity is good, that coverage ratio is good, all those other markers. So it's just an example of the difference between what I would call hard guidelines, or hard and fast rules that say, this is all we do, it's all we ever do, and we don't care about any of those other numbers. And we certainly don't count on them getting repayments from their company, to a guideline that's a guideline that says we generally use 16D if 16E is significant and recurring, and it is required to make the cash flow work. Ask more questions. Understand what's going on. Understand whether their liquidity is holding even though they're making these payments. Understand how much longer, they're going to get them. So that's the one that I call a sleeper, because I think that 16E has not been on the radar. And frankly, until I had that experience, it didn't occur to me that it should be on the radar. And because I had that experience, I realized that absolutely, if you wanted to understand my cash flow at the time, whether it was a personal deal or an entity deal, you really did need to see both of them. That's the sleeper. That's the one I think people are missing. And it's a good example of why those of you responsible for setting out guidelines, when there are other things you would consider if you spotted them, but you don't know whether your junior folks will ever spot them because it's not in your rules, right? So we need to find the way to say two things that David and I regularly say. One is it depends, and the other is check your guidelines. People need to know this is what we normally do. If you see something unusual out of the order, bring it to me. Let's talk it through. There may be something we can do with that. We'd prefer, of course, to qualify everybody without that 16 code of E. And if we can do it, great. But if we can't, and it's there, and it's significant, and it's recurring, and it really does better reflect the cash flow back and forth, it would be good if we could spot it and make a good decision about it. I think that is it. So 1120S, K-1, line 16D, maybe E, capital contributed, is not showing up anywhere. That's it for today. We would love for you to send in your own questions to experts@lendersonlinetraining.com. That's where we get the ideas for the live streams. That's also where we get the questions for our blog post process, Ask the Experts, which you can sign up for as well by going to our website /asktheexperts. We always answer your questions, and either through this live stream or in our Ask the Expert blog posts, which come out once a week. Subject line says what the question is. Look at it if you have that question. Ignore it if you don't. These are just two of the ways, in addition to the training that we actually do with a lot of lending and credit analysts. These are two of the ways we just throw information out there and see if we can help the banking community say yes to more good loans. Thanks for joining us, everybody.